Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to talk about investing strategies. So I asked Bing Copilot to give me the common investment strategies that it knows, and it gave me the next 10 investment strategies in the order that I'm going to name now. So first off, value investing, then growth investing, then momentum investing, dividend investing, index investing, dollar cost averaging, contrarian investing, sector rotation, technical analysis, and fundamental analysis. You might say, okay, so now what? Well, I decided to split them up and in a different order as well. So first off, I'm going to talk about fundamental analysis and technical analysis, as I think that without fundamental analysis, you can't do a lot of things in the next investment strategies. So then you have value investing, growth investing, and dividend investing. Then I'm going to talk about index investing and dollar cost averaging. Then I'm going to talk about momentum investing, contrarian investing, and sector rotation investing. And as you might notice, there is nothing about core satellite strategy, and it might seem contradictory, but it is actually core satellite portfolio. So it isn't a strategy. It is just how your portfolio looks, and it is not really an investment strategy. You use an investment strategy to build up your core satellite portfolio. So with your investment strategy, you decide what you're going to buy, which ETFs, which stocks you're going to buy, and how you're making it up. So 80% in ETFs or 60% in ETFs, 20% in defensive stocks, and 20% in more growth-oriented stocks. That is just a decision. That's just how you want your portfolio to look. That's not actually a strategy. But it's really important that you decide before you start investing which strategy you're going to follow and how you're going to build up your portfolio. So fundamental versus technical analysis. If you look at fundamental analysis, there you evaluate financial statements. So you have the price, and from that, with the financial statement, you can calculate the PE ratio, you can calculate the PEG ratio, you can price to book value and stuff. You can all calculate that. You can see how the revenue is evolving or the cash flow is evolving. So that's all really important to look into before you buy a certain stock. Also, you need to know whether or not a company has a competitive advantage and whether or not the management is good, yes or no. And as I said in previous videos, knowing whether or not the management is good, yes or no, that's really difficult for us as small investors. And from all that information, you try to predict the fair value and whether or not you can buy it now, whether or not it fits your investment strategy. And for me, this is long-term investing. Then you are a true investor. On the other hand, you have the technical analysis. There you evaluate the market data and you look at charts with, for example, price and volume, or with moving averages together with price and volume. You try to recognize patterns and trends, and from that you try to predict future movements. So in the short term, you try to make a profit either with a price gain or a price loss, so when you trade short. And in this instance, I call this short-term investing, namely trading. And I want to emphasize that you always have a gambling factor when you are investing, but you are truly gambling in the first three scenarios, and it is in the order of very high gambling to lower gambling. So traders that don't look at fundamentals, that just trade blindly into stocks without even knowing what those companies do, they are truly gambling. They can make a profit on the short term, if you are really, really, really good and you are exceptionally lucky, you can make a profit for your whole life. It is possible, but I wouldn't advise it. Then you have investors who neglect the fundamentals and invest anyway. So they just follow their gut feeling instead of looking at the raw numbers. That's also really gambling. Then you have traders who do look at fundamentals, but are still trading off of a short. So for me, that's still gambling because patterns, yeah, for some guy, a pattern that is visual is visible on a chart can mean that it's going to go up, and for others, the same pattern can mean that it's going to go down. So who is right? Yeah, the one that makes a profit is right, but the other one makes a loss. So yeah, it can go either way. And then you have the lost group. So it's also gambling because you always make a decision based on numbers, and you never know how the future is going to look like. But you make the most educated guess when you are an investor for the long term and you look at the fundamentals and you make an educated guess for which stock to buy. So for me, the first three are most likely to lose money on the stock market, and the fourth group is the most likely to win money on the stock market. Then you have value versus growth versus dividend investing. So value investing, those investors focus on undervalued stocks that are trading below their intrinsic value or their calculated fair value, because most of the time, you don't find stocks that are trading below their intrinsic value. It's really hard to find nowadays, especially on the stock market. And you can even go and argue that you can invest into companies that have a lower PE value than their other competitors. I don't like it because there you have to actually invest in something that sometimes is really overvalued, but compared to their competitors, they are undervalued. So for me, it's between parentheses, but a lot of people do it like this. So they look in a certain sector, they see that on average the PE in the sector is 18. There is one company that trades at a PE of 13. They look at it, they say, okay, it's actually rather nice. Why isn't it at a PE of 18? So they buy it, and then they hope that other investors bring it up to a PE of 18, and then they take their profit. I don't like to do that. So just so you know, but a lot of people think that is also value investing. Then you have growth investing, where you focus on companies that are expected to grow at an above average rate compared to other companies. And many of those companies pay no or a very low dividend, as their focus is on increasing their growth as much as possible. So they don't pay out a dividend or a very small dividend to their shareholders. And then you have the other opposite side. There you have dividend investing, and those investors focus on companies that pay out a regular dividend. And it's really important that it is regular because you try to have a steady income stream. So some some investors focus on high yielding stocks and other investors focus on dividend growth stocks. For me, it doesn't actually matter. I just like to buy stocks that pay out a dividend and are a bit undervalued or seriously undervalued. If they don't pay out a dividend and they are undervalued, I'm still going to buy them, but yeah, it's just the way I do it. Then you have index investing and dollar cost averaging, and I think those two belong together because when you are in index investing, you invest towards an index, and which one, it's your decision. But for example, let's say we invest in a world index. So a world index with 100 stocks like the SGPX ETF, and you just follow that index blindly. So you don't do fundamental analysis or whatever. You just say, okay, the index does the analysis for me. Those 100 companies are in the index, so I just buy them. And you can do it yourself, but I wouldn't advise that because that's really expensive. But you can also use a fund, and that can be a mutual fund or an ETF. It actually doesn't matter that much as long as the total expense ratio is cheap. Most of the time, the ETFs are the cheapest ones, but there are also mutual funds, especially from Vanguard, that are really cheap. So as long as they are passive, that's the way to go. You can find a lot of mutual funds and ETFs on the stock markets. So just do your research, look at videos on my YouTube channel. Although I only talk about ETFs, but there are mutual funds as well, just so you know. And a way to do it is then actually the lump sum or dollar cost averaging. So the Copilot didn't name lump sum investing because it's also just a way to do it. And I don't think dollar cost averaging is actually a strategy, it's just a way to invest money into one of your strategies. So, and as you know, I don't like the name dollar cost average because it has dollar in it, and yeah, we are here in Europe. We have Swiss franc, we have the euro, we have the pound. So yeah, when you live on the European continent and you read dollar cost averaging, you are already a bit like, yeah, but we don't use dollars. So I like consistent cost averaging more. So CCA. So you can also do both. So first start off with a large sum and then start with putting in money regularly, like monthly or weekly or even quarterly. And you can do that into the stock market. So if you like index, you buy the index, an ETF, but you can also buy a stock. I wouldn't recommend to do it in one stock because then you put all your eggs in one basket. But now with fractional shares, for example, you can set up a savings plan to invest towards 10 stocks that you really like. You like the 10 companies, so you say every month I invest 20 euros towards each of those 10 companies. So you invest 200 euros every month and you split them up accordingly to yeah to the companies that you want. So it's a way to do it, but actually I don't think dollar cost averaging or consistent cost averaging is an investment strategy. It is just a way to invest into a strategy. Then you have momentum, contrarian, and sector rotation investing. So momentum investing is investing in companies or sectors that show an upward trend. So actually it's more a technical way of looking at things. And the aim is to capitalize on continuation of existing trends and make a gain like that. Then you have contrarian investing, and they do actually the opposite from momentum investing. So they try to buy the stocks that are at the bottom or in a downward trend. So they aim to capitalize on market overreactions. So when a stock is trading down because of bad news, and it trades down 10% instead of only 1 or 2%, the contrarian investor is going to say, hey, I want to pick that one up. They are going to, yeah, they are going to pick the stock up, and yeah, even 2-3 weeks later, after the news has sank down and it went up again 5-6%, they are going to take profit. So actually, it's also more or less more short-term trading, but not really day trading like you have when you are really looking at charts. And then you have the sector rotation, and where you are trying to move from one sector into another based on expected performances. And so they try to capitalize on economical cycles. And a cycle looks like this. So you have the conjunctural cycle. So here it is high, here it is low when you are in a recession. And the arrows means how the interest rate of the Fed or ECB or the S&P is. So when it is on the top of the high conjuncture, the interest rate is flat, and on that time it is actually, yeah, it is rather high, and then the interest rate starts sinking, and then you have stocks that are sensitive for interest rate cuts, like, yeah, when the interest rate goes down, then the banks are actually going to perform really badly because, yeah, their profit, when the interest rates are high, they have normally higher profit, and when the interest rates go down, their profit margins are going to go down. Real estate, in the contrary, because the interest rates go down, they have less costs to buy new real estate. So for real estate, the interest rate coming down is really positive. But then at the bottom of the recession, the interest rate stays flat again, and there you need to invest into cyclical companies like in the automotive sector, the construction sector, or the hotel sector, or something like that. And after that, the interest rate is going to go up again, and then you need to invest into defensive stocks like in utilities or healthcare, pharma. And when the interest rate is going to go up again, then it's also time to start investing into banks, because, yeah, the banks profit when the interest rates start to go up. And real estate, they are going to begin to perform worse. So buying banks now, then, and then real estate, selling real estate, making the exchange between both, that's also always a good idea in the beginning of a interest rate hike. What am I for an investor for ETFs? Well, you know me, I'm a dividend investor for ETFs, as I only invest in ETFs that pay out a dividend. They make up the biggest part of my portfolio, or our portfolio, I should say, in fact, because it's the portfolio of my wife and me, and the core being mainly global and European dividend ETFs. Sadly enough, a lot of in euros, and we are living in Switzerland, of course, and the euro is not that strong for the moment. So this year I made a lot of profit, but I could have made a lot more if the euro performed 5 or 6% better than it actually did this year so far. And why I like dividend ETFs? Well, I know that accumulative ETFs perform slightly better, and this will make a huge difference after 20 or 30 years of investing. I know this, but I'm already 43, so if I was 20 years, I would probably invest in accumulative ETFs as well. But yeah, I'm already preparing for my pension, and I don't like selling things. So I'm actually a long-term investor, and when I buy an ETF, I don't want to sell it anymore. And that's why I like the dividend investing, because then when I retire, I don't need to sell off every year a part of my ETFs that I accumulated over the years. And I like seeing the steady progress of the dividends that I receive. And this keeps me motivated. And I think that's a really key point, because seeing the dividends come in even when the stock market crashes, it keeps me motivated to keep investing also in the downturns. So a lot of people neglect this fact, but then they invest 5 years into accumulative ETFs, then suddenly it loses 50% of its value, and they say, hey man, I had 100,000, now I have 50,000, I put 80,000 in, and I lost actually 30,000 of my money that I invested. Well, I don't have that problem. I invested 80,000, and I will receive on that point, I hope, around 3,000 Swiss francs in dividend. So the only thing that I will see in the moment that it is 50,000, that I can buy the ETFs that I'm already buying for 5 years are way cheaper now, or way cheaper then. So I can buy more at a cheaper price with a higher yield on cost again. So I will be happy with the dividends. And then what am I for an investor for stocks? Well, there I am a value investor who likes to receive dividends. So I will also buy a company that doesn't pay a dividend if it is undervalued, that's for sure. Most of the time here in Europe, that's really hard, and I will get to that at the end of this slide. But I don't look at stocks as being dividend or growth values, not even as dividend growth companies. I just try to buy companies that are at a good valuation. This makes that I often fall in the contrarian or sector rotation category with my trades because, yeah, those companies tend to do not that great on the moment that they don't perform great, and at that time they become undervalued. So then they come on my radar, and then I start buying them. But I actually don't focus on being a contrarian or being, yeah, focused on sector rotation. So I don't focus on buying banks or selling banks on a certain time of the economical cycle. So I just look at the value. I decide on the companies that I like. I continue to follow them up, and if they are undervalued, I start buying them. I'm also a fundamental analyst. I like reading yearly reports. I look at charts as well, but only to find certain resistant price levels for stocks. So I think there is something that you need to have an eye for, because when you want to buy a stock and you see that there is a certain resistance level just above the price where you want to get in. For example, you know that a stock, when it comes to a price of 19 euros, for example, then it has a PE of 18. But yeah, it's momentarily trading at 22, so you hope that it falls to 19, but you see that a lot of people were trading around 20, then you know that the the level of 20 to fall below 20 euros is going to be really, really, really hard. So then there really needs to be a big crisis or a crash, or suddenly the company has to put out really bad numbers to fall below 20. And when the company comes out with really bad numbers, then you also have to recalculate whether or not you're going to buy it at 19. So it's always something you have to keep in the back of your head. So for me, putting a label on your trading strategy is always hard. And the best thing you can do is write down some ground rules and stick to them. So for me, for ETFs, I invest in dividend ETFs that have a decent track record, and I consistent cost average into them. And for stocks, I want stocks that have a certain moat. I don't want stocks that have a negative earnings per share. For me, for example, BASF right now, it's a really hard one. It's just barely negative, the earnings per share, but it's negative, so I can't invest into it. I'm waiting until it turns it around to a positive number so that I can start investing into it. It's on the list of 20 stocks for the U portfolio, but momentarily, although everything looks quite good, it has a negative earnings per share, so I can't invest into it. And Bayer as well. So two German stocks that are on the list with a negative earnings per share, and where I'm waiting for the company to turn things around before I start investing into them. The revenue profit must be growing, so then I use also my own PE table for doing my value calculations, and you can see my video series about that. Maybe I will put the link in the video below so that you can click on that link to watch those videos. Then I always aim to have a PE below 18 when I buy my companies, and for banks I want it to be below 10. That's also a rule that I instated after I had about in 2007 2008 I lost a bit of money, a lot of money then from investing into Fortis. A lot of people from Belgium know Fortis, and that's why I didn't participate in Credit Suisse. So payout ratio below 60% for the dividend. I think that's a really important one. But for insurances, it needs to be below 80%, and for real estate, it needs to be around 90%. Because for certain sectors, of course, you can make an exception. But I like the payout ratio to be below 60. And you can say, hey, you bought Swatch when it only has a payout ratio of 65%. Yeah, but there the book to price ratio was 0.70, so that's why I made an exception. The the book value of a stock when it's below 1 compared to the price that you have to pay, that makes up a lot. So yeah, I made an exception there. And if you make an exception, it is also really important that you write it down with your purchase, why you did it, so that later on you can still track whether or not your reason to buy the stock was actually valid, yes or no. And I know that when you buy decent stocks, decent companies below their book value, that most of the time you will make money on it. And for Swatch, that's for me, I think, really the case. And unfortunately, one negative point about how I invest is that there is a lot of small growth stocks that are really interesting. And yeah, I read magazines as well, and there are some great companies around, but they are still in their growing phase where they are still not making a profit. And when a stock isn't making a profit, I'm not investing in it. So biotechnology, that just passed by me completely. I haven't invested in biotechnology, so yeah, as long as they don't earn money, I can't put my money towards it, because my aim for investing my money is always to get my money back in the form of dividends or in the form of selling the company after 5-10 years with a huge profit. And with that being said, I thank you for watching to this one. Please consider subscribing to my YouTube channel. Hitting that like button helps out the channel as well. So thank you for doing that as well. And with that being said, thank you for watching to this one, and see you on the next one. Bye.